Hi everyone, my name is Muhammad Rafiuddin Omar Zulfadli bin Muhammad Roslan. My metric number is ZP03802. So I'm going to present to you today about Nike's case study. So the case study is about cost of capital. First of all, let me brief to you about Nike. So Nike is a US-based sportswear company, and it is involved in many business segments. They're involved in footwear segment, and the footwear segment actually contributes 62% of its business revenue. And sportswear apparel complement products to the footwear, and this contribute about 30% to the business revenue. And sports equipment contribute about 3.6% to the business revenue. And casual wear non-Nike brands, well, basically they only contribute about 4.5% to the business revenue. So in the case study, the current share price is about 42.09 US dollars. So the case study was in 2001. So the background of the case study. So the case study is about this fund manager. Her name is Kimmy Ford. So she was a fund manager at North Point Group. So she was managing North Point large cap fund, which invested mostly in Fortune 500 companies. So basically, what happened to Nike share in 2001 is that the price had fallen since the beginning of the year. So she would like to know what to do with Nike share, whether to buy or to actually hold the shares. So Lehman Brothers analysts recommended a strong buy where they had their reasons, and then Credit Suisse and UBS Warburg recommended a hold. So basically, there were mixed opinions about Nike shares forecast. So therefore, Kimi actually decided to create her own analysis to come up with her own conclusion about Nike shares, because Nike actually held meetings to actually communicate a strategy to revitalize the company, because that their net income had actually fallen from 800 million to 580 million, and their market share is decreasing. Their market share is about 48% in 1997, and it has decreased to 42% in 2000. So they plan to boost their revenue by actually increase their production, or by increase the development of footwear in the mid-size segment. And they're willing to put more effort on expense control, and they're also forecasting a long-term growth of about 8 to 10%. So the first analysis that Kimi decided to do was the discounted cash flow. So the discounted cash flow, she wanted to perform the discounted cash flow analysis to actually forecast the share price of Nike. So the assumptions in her discounted cash flow was that the cost of capital was 12%, the terminal value growth rate was 3%, and the tax rate was 38%. So by performing the discounted cash flow analysis, she came with this result. So the enterprise value was about 11.4 billion. So the equity value she found, when you minus the enterprise value with the current outstanding debt, which was about 1.29 billion, she got an equity value of about 10.118 billion, and the current shares outstanding at the time was about 271.5 million. Therefore, she came out with the equity value per share of $37.27. But then the current share price is about $42.09. So based on this analysis, the current share price is actually overvalued. So we have to remember the cost of capital that she used was 12%. So Kimi Ford's result. According to her forecast, Nike's current share price is overvalued with cost of capital at 12%. And then Kimi decided to actually perform a sensitivity analysis according to the discount rate or cost of capital. So according to a sensitivity analysis, at a discount rate of below 11%, the share price would actually be above $42.09, which means at a discounted rate of below 11%, the current share price is actually undervalued. So she had to come up with her own weighted average cost of capital, as you can see here in the slide, the universal calculation of weighted average, which is the weightage of equity times the cost of equity plus the weightage of debt times the cost of debt minus tax. And then she decided to calculate the cost of debt by dividing total interest expense for the year 2001 by the company's average debt balances. So the average debt balances was the debt balance in 2001 plus the debt balance in 2000 divided by 2. So the debt balance that she got was about 1.37 billion, whereas the total interest payment in 2011 was 58.7 million. Therefore, her cost of debt before tax was 4.3%, and the tax rate, well, she decided to put a tax rate of 38%, and then the cost of debt after tax was 2.7%. That was the cost of debt. And then she decided to calculate the cost of equity using the capital asset pricing model. So assumption was the risk-free rate was 5.74% and the beta was 0.8%. So and then the market risk premium is the compound average premium of the market over the treasury bond. So the cost of equity that she found was 10.5%. With the debts weight at 27%, and then the equities weight at 73%, and the cost of debt 2.7%, cost of equity at 10.5%, we can put Kimi's WACC calculation together. So when we put the WACC calculation together, we got about 8.4%. So we have to remember that the cost of capital, her assumption of cost of capital at the beginning was about 12%, and now we get a WACC, weightage average cost of capital of 8.4%, which is way below 12%. According to her table at the beginning, at 8.4%, the share price of Nike is valued at a range from $67 to $75. So we can see that at a weighted average cost of capital of 8.4%, the current share price is actually way undervalued. But then there are also other methods to actually calculate the cost of debt to find out what the actual WACC is. So we can use the yield to maturity model. So we have below information on Nike's bond. So the coupon rate is about 6.75% and the current price at $95.60. So we assume that we still have 10 years to maturity. So we use the financial calculator. So we found a yield to maturity of 7.36%. So that's the cost of debt. So the cost of debt after tax, assuming the tax rate is actually the same as Kimi Ford's at 38%, so the cost of debt after tax is about 4.6%, which is higher than Kimi's cost of debt at 2.7%. And then there are also other methods to actually calculate the cost of equity. So we can use the dividend discount model or the capital asset pricing model. There are several advantages and disadvantages regarding these two models. So when it comes to dividend discount model, the advantages are actually it is quite useful and it also straightforward. However, the disadvantages are it does not apply to companies that do not pay dividends, and it is also sensitive to dividend growth rate changes. At the same time, it does not explicitly consider the risk of investment, whereas capital asset pricing model, they actually explicitly consider the risk of investment by factoring in the risk-free rate and market risk premium. However, it relies heavily on past information or past data. So the cost of equity using the discounted dividend model, you can see here the current share price is about $42.09, and then the current dividend, which is 0.48%, 0.48 cents. You have to multiply. You have to factor in the growth rate at 5.5%, which is based on the article. So the cost of equity using the DDM, we get about 6.7%. Which is lower than Kimi's cost of equity, which was about 10.5%. And using the capital asset pricing model, we can actually use the current yield on 20-year US Treasury bond as the risk-free rate, and the market risk premium at about 7.5% using the arithmetic mean that was given by the article, and the beta at about 0.8%. So the cost of equity using capital asset pricing model, we got about 7.15%, which is still lower than what Kimi has found as a cost of equity. Her cost of equity was about 10.5%. So from here, we can actually calculate the new WACC. You can see here that the weight of equity remains the same, 73%, weight of debt about 23%, and then the cost of debt after tax about 4.6%, because we calculated using the yield to maturity, and then the cost of equity using the capital asset pricing model at 7.15%, and then using the discounted dividend model at about 6.7%. So the WACC using the discounted dividend model, we found we get about 5.9%, and using the capital asset pricing model, the WACC is 6.3%. So you can see here in the table, the equity weight remains the same. The cost of debt after tax, well, it changes. It was 2.7% under Kimi Ford's analysis, and now in our analysis, about 4.6% using the YTM. And then the cost of the cost of equity for Kimi Ford's analysis was about 10.5%, whereas our analysis is 6.7% and 6.7% and 7.15%. And the WACC here also, we have found a WACC much lower than Kimi's WACC. Kimi's WACC was about 8.4%. We found WACC at about 5.9% and also 6.3%. So it is much lower than Kimi's WACC. So what we can conclude here is that the share price should be actually above the current value. So the conclusion and recommendation on this share is actually based on the sensitivity analysis performed by Kimi Ford. What we can see at 8%, the share price is valued at $75.80. So basically, with a WACC of 6.7% and also 5.9%, so the share price should actually be higher than $75. So our recommendation here is to actually concur with Lehman Brothers analysts, and we recommend a strong buy on the shares because the current share price is actually undervalued at $42.09. So we believe that the share price should reflect the current the value of the company, and based on our forecast, the share price should be above $42 because the cost of equity is lower in our calculation. So and then also we have to factor in the constant dividend payment of Nike. So we believe that Nike has been paying dividends consistently. So therefore we recommend a strong buy on these shares. So thank you very much. I hope I have shared enough in this presentation. I hope this helped you to understand WACC a bit better and its role in calculating the share price. Thank you.
Hello. Hi, my name is Norfad Yaakob Rahman, ZP04004. Today I'm going to actually talk about a case study regarding on Teletech Corporation. Teletech Corporation is a case study on weighted average cost of capital. So before we going to go through on the case study, first we would like to understand what is the background of this company. So Teletech is a U-based telecommunication company. They has two business segments, which is inclusive of telecommunication services, which provided a long distance, local and cellular telephone service to business and residential customers. And second, they also involved in product and systems, which their main focus is to manufacture of computing and telecommunication equipment. So in terms of the proportion of both segments, so based on market value proportion, so 75% of the company is belong mostly are from telecommunication services. So in terms of return on capital for telecommunication services based on 2004 is 9.1%. Their net asset is $11.4 billion. Their revenues is about $11 billion. Their net operating profit after tax with the tax at 40% is $1.18 billion. And their earning before interest and tax is $1.97 billion. And their operating expenses is $9.03 billion US dollars. And their operating expenses per revenue is about 82%. Meanwhile, in product and system, 25% of the market value of the corporation is in product and system. Their return on capital is about 11%. Their net asset is $4.6 billion US dollars. And their revenues is $5 billion. Their net operating profit after tax, which is not bad, at at a tax of 40% is $480 million. Their earning before interest and tax is $800 million, and their operating expenses is about $4.2 billion, and their operating expenses is about 84% out of their revenue. And in terms of corporation, their total net asset is about 16 billion US dollars, and their revenues they generated in 2004 is 16 billion US dollars, and their NOPAT is about 1.66 billion dollars, and their earning before interest and tax is 2.77 billion dollars, and their operating expenses about 13.23 billion dollars, and their operating expenses against revenue is about 83%. So from here we can see that in terms of return, product and system actually provide higher returns compared to their telecommunication services. However, in terms of operating expenses, product and system actually use a bit more, which is about 84% compared to operating expenses under telecommunication services. So next, what we're going to see is in terms of what are the main issue of this case study. So the main issue is currently Teletech Corporation are using a single hurdle rate, which is W weighted average cost of capital, WACC, to determine the cost of capital for both segments. So based on capital market, each segment have different rates of return and risk. For product and system, which consists of telecommunication equipment and computer and network equipment, it's a bit high risk, and on average and it's a bit volatile to the market, with their average beta about 1.36. Meanwhile, in telecommunication services, it's a bit low risk, and the movement of the stocks against the market is according to the market, with their average beta about 1.04. So what they are currently using with the single hurdle rate is basically to determine for economic profit application. So based on the formula that they provided, the economic profits is equal to return on capital minus hurdle rate times capital employed, where ROC is return on capital equal to NOPAT divided by the capital, and NOPAT is net operating after tax. For NPV application, the hurdle rates are used as follows: net present value equal to from T to N, with T equal to 1, free cash flow at T divided 1 plus hurdle rate by the power of T minus initial investment. And they're using this hurdle rate for a few reasons. For economic profit application, basically they want to understand the performance of the segment, and also business unit and also for executive evaluation, and also to provide a strategic decision consideration, such as capital allocation, manager promotion, and incentive and compensation. For NPV application, it's all about is basically for assessment on capital investment proposal. So to see whether the proposal is actually acceptable to be implemented, or they have to actually or they actually have to forego any capital investment proposal. So the advantages and disadvantage of single hurdle rate is advantages: it represents the whole corporation, and also easier to determine economic profit and NPV for any business segment or capital investment proposal as a holistic approach. However, disadvantage of single hurdle rate is it does not consider risk for each segment. A different segment has a different risk and capitalization, and it basically does not reflect the true cost of capital and rate of return for each segment. So solution is basically the best solution to make sure that the company actually perform well and provide a true return or true nature of the business or performance company. Is best to basically divide their hurdle rate into two segments, which is focused on: number one is telecommunication services, and number two is product and system. So the best way is to create multiple hurdle rate for each segment using the risk adjusted hurdle rate as follows. WACC for Teletech equal to weightage for telecommunication services times WACC for telecommunication services plus weightage for product and system times WACC for product and system, where W is percentage weight based on market values, and WACC for telecommunication services is weight for depth for telecom services times rate of cost of debt for telecom services plus weight of equity times rate of cost of equity for telecommunication services, and WACC for product and system is equal to weightage of debt for product and system times cost of debt for product and system plus weightage of equity for product and system times cost of capital for product and system. So before we actually can start using this solution, we actually have to come up with a few assumptions. So number one is weight of debt to telecommunication services, it should be equal as weight of debt for product and system, which is equal weight of debt, which is 22.2%. Meanwhile, for weight for equity telecommunication services should be equal to weight of equity for product and system, which is equal to weight of the corporation for equity, which is at 77.8%. Beta and second, beta for telecommunication services should be same as average beta for telecommunication services industry beta, which is at 1.04. Beta for product and system, it should be average beta for telecommunication equipment industry and computer and network equipment industry, which is at 1.36. Market return for telecommunication services as per return on capital for 2004 is 9.1%, and market return for product and services as per return on capital for 2004 is at 11%. Of the solution as follows. For WACC for telecommunication services, with the weight of debt is 22.2% with a bond rating of A. Pre-tax cost of debt is 5.74%, tax rate at 40%. Pre-tax cost of debt is 3.44%, weight of equity at 77.8%. Equity beta at 1.04. Return of free risk will be 4.62% based on US Treasury bond for 30 years. Risk from return of market is 9.1%. So return of market minus return of free risk is 4.58%, and cost of equity at 9.38%. So the WACC for telecommunication services will be at 7.98%. Meanwhile, for WACC for product and system will be weight of debt at 22.2% with a bond rating of BB, with a pre-tax cost of debt at 7.47%, tax rate at 40%, pre-tax cost of debt at 4.48%, weight of equity at 77.8%, equity beta at 1.36, return of free risk is 4.62%, the rate of market is 11%, rate market minus rate of free risk is 6.38%, cost of equity is 13.3%, so WACC for product and services will be at 11.34%. From the WACC that we actually calculated for telecommunication services and also product services, we can actually calculate the WACC for weightage average of cost of capital for whole corporation of Teletech. So using the market value of asset weight for telecommunication services, which is at 75%, so WACC for telecommunication services is 7.98%, and market value for asset weight for product and systems is 25%. So WACC product plus product and system is 11.3%. So WACC for Teletech at 8.82%. So in conclusion, the risk-adjusted hurdle rate reflect lower cost of capital than previous hurdle rate, which reflect the proportion of the firm is more to call telecommunication services than product and system, which is the risk-adjusted hurdle rate is 8.82% compared to previous single hurdle rate, which is 9.3%. The risk-adjusted hurdle rate reflects better on each segment. Budget allocation can be done more effectively and efficiently because the risk-adjusted hurdle rate represents each segment. Teletech Corporation performance review reflected through the risk-adjusted hurdle rate, and better strategization consideration can be done accordingly. So this is basically the company can answer to the readers by telling them that because they come up with a new hurdle rate, so they require time to actually to evaluate all the situation before they can decide on the best course of action in terms of whether to sell off their product and service and product and system segment, or just continue in the company. But currently, based on the rate, is basically I would say that the company should hold to their both segments for the time being until a more understanding of the segment in the future can be done. Thank you from me, and hope that you hope that you have more understanding about this case study. Thank you very much.
Hi, my name is Haziq. My metric number is ZP03887. I would like to introduce to you about the American Greetings case study. First of all, we'll see the company's overview. American Greeting was founded in 1906, mainly focusing on design, manufacturing, and distributing cards, or they call it social expression products. Their main products are greeting cards, mainly for birthday, festive, as well as special occasions. And then they also supply parties, wares, stationery, and gift wraps. Their major greeting cards brands are American Greetings, Papyrus, Recycled Paper Greetings, and Carton Cards. So they have worldwide operation, mainly in the United States of America, Canada, United Kingdom, Australia, and New Zealand. So what is actually social expression products? They actually manufacture and distribute electronic greetings and worldwide of a wide range of digital content services as well as products. So some of the products are actually being sold on the website, internet portals, as well as on the mobile devices. They also engage in design and character licensing, for example like strawberry cupcake as shown here. Before we go further into this company, we will see first the industry overview. Global market for greeting card segments actually projected to be downward trend, further down to 21 billion USD in 2024. This is mainly due to influx of mobile communications devices and the growing use of social media and e-cards. As you can see in this figure, the percentage of annual change are expected to be declined at the average around 2% each annually. So other major factors impacting the market growth is the changes of consumer behavior, especially in terms of their value and ideas. So nowadays consumers are expressing their feelings and emotion in a different ways as well because of all these changes in social media platform and communications. So in this business case study, we want to examine the 2012 decision by American Greetings whether to repurchase their shares. American Greetings share price have been declining or cut in half to a year-end closing of $12.51 in 2011. Historically, their management had always turned to share buybacks at times of low valuation. Therefore, at this current market valuation, we want to see whether we should recommend for the management to proceed with buyback, or if the company stock is or they need to preserve the cash for future use. Next, we look into their business strategy analysis. Based on American Greetings Annual Report 2016, they were facing intense competition from a wide range of companies, including from first the traditional greeting card businesses. Mainly their main competitor, which is Hallmark. Hallmark actually owns 4 billion USD in terms of market share revenue in the US alone. Secondly, social media companies that host and enable mobile access to and posting of greetings and images, such as Facebook, Instagram, Twitter, Pinterest, and Google+. Other than that, they also have intense competition from photo hosting website such as Flickr, Picasa, Google, Apple Cloud, iCloud, etc. Next, they also have competition with big box retailer, drugstore chains, which offer the consumer the ability to actually create their personal greeting cards as well as other social expression products. Next, specialized companies that offer electronic greeting cards such as Hallmark, Tiny Prints, etc. As well as small and specialized companies that sell their products using online marketplace such as Amazon, Etsy, and Pinterest. We dissect it even further in terms of their financial analysis. Based on the data given by the business case study, we actually have data from peer groups of American Greetings. So we even calculated their cash to debt ratio, as well as EBITDA margin, ROA, as well as ROE. From all this, from the analysis, we can see that American Greetings' financial performance was actually lower than in all indicators against their peer group average analysis. So based on the industry overview as well as business strategy analysis, it can be concluded that American Greetings is facing intense competition while having to operate in a downward market trend. So as mentioned, they are also, based on the financial analysis, they are also was not performing well compared to its peers group average back in 2012. Thus, we can conclude that the declining stock price was reflecting on American Greetings' performance and was not simply out of favor by the investors. Therefore, it is recommended for American Greetings to use the estimated $75 million to buy back shares to further strengthen its products and improve on financial performance to increase their stock's valuation. Thank you.